Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. Well, David, we're celebrating Thanksgiving this week in America, and as near as I can tell, a significant chunk of the population of Florida has relocated to your home in Gretna. How are you holding up?
That's why I'm a workaholic. I'll be here all weekend. No.
Was that a cot I saw set up in your office?
So yeah, we've got.
Typically, people do stay home on Thanksgiving, David. So,
yeah, we have. My wife and I have hosted about every 7 or 8 years. So we've been married 32 years, and so we host about every.
Up this year?
Yeah, so it's our turn, and we were at a family get together last year, and one of my nieces like, "Why don't we all go to Omaha?" And I had an adult beverage in my hand. Sure, come on. And my wife has been yelling at me ever since. But anyway, yeah. Okay. So we had to. We actually built an extra bedroom in our house actually just 2 months ago to help accommodate all the people coming. So we now have a 5-bedroom house instead of a 4-bedroom house. Did some renovations.
Well, the last number I heard was well into double digits.
Yeah, we got 18 for Thanksgiving. So and a bunch of little ones that will potentially see their first snowfall. So I've got some grand nieces and nephews that are going to be at the house that have never seen snow living in Central Florida.
Actually,
so fun we'll have some fun. We'll have
the rest of us, here
bundle
comes
them
winter.
Up. But anyway, it's my favorite holiday because it's the least commercialized, if you will.
True.
It's a time of fellowship and fun and just to reflect and give thanks. And so we're just blessed to be able to host this many people. So
well, great. Hope everyone's having a great Thanksgiving week and Thanksgiving weekend. David, we pride ourselves on being a full-service firm, but we plowed new ground recently.
Yes, we did.
We had clients who became legally married. And Tej, one of our client specialists, a client service specialist, she took client service to a whole nother level. She, with the help of some colleagues, decked out our Osborne conference room with wedding-related decorations. Mary, whose main job is wrangling you, your scheduler, but she baked a multi-tiered cake that would have put commercial bakers to shame. And we staged a mini wedding here at Retire Smart. Tell folks about it.
Well, that is the power of tax planning. So the clients, and we won't name them to save them from any weird conversations with their families, but okay. Basically their families believe they already got married. They pulled off a mock wedding previously, but they chose not to legally marry because they thought they were going to be penalized, in particular in the healthcare arena, because income disparity, et cetera, and one was getting some tax benefits. However, with tax planning, our astute advisory team showed them it'd be much more powerful to institute our number one tax strategy in the current time period, in particular Roth conversions with some other strategies, to save them well over $100,000 in taxes for their retirement if they were legally married, understanding the tax code allows us to push income up in the same bracket.
You don't know what you don't know.
So it was like, hey, do we pay $6,000 more over here to save almost $200,000 over here? That was a pretty easy decision. And lo and behold, they said, well, that's great because our family thinks we're married. Can we just get married here? And the team just said yes. And then I was like, what? and then I ran it by my brother Lou, who's of course our chief compliance officer. He's like, we have no problem with it. So exactly, Osborne was turned into a wedding chapel, and we celebrated a wedding, and it was awesome. It was a lot of fun. So this was a first for me. And but anyway, it just shows you we want to take full service to the max, and the power of true tax planning.
Well, so now people have been brainstorming if this is going to be another David Brooks company, Smart Nuptials, Smart Marriage.
Yeah, my wife said no more companies. I can't promise that. Okay. I promised her till death do us part when we did our nuptials, but I won't promise to stop starting companies.
Fair enough. All right. Hey, into the financial news we go, David. And you told the team recently at our weekly team meeting, the markets seem to like the Trump cabinet picks, at least as they relate to economics and finance.
Absolutely. So our Treasury Secretary has been announced, and Scott has been a hedge fund guru for quite some time, and he has logic. He understands the marketplace, and he's going to follow what he calls a 3-3-3 rule. And so this will be disruptive. I will tell you, the markets, we'll call it the Trump bump here since the election, have moved up. They are starting to kind of maybe just move sideways at the moment. And eventually, I still think we're going to have some form of deep correction because valuations are still way out of whack. But basically, his 3-3-3 rule is to help the economy grow. We cannot have a deficit more than 3% per year of GDP. We're currently about 7.5%. So that means significant cuts in government and the Doge, et cetera. Elon Musk and Vivek are going to be leading this Department of Government Efficiency. So that means they're being serious, and the Treasury Secretary is going to be behind it. Well, the current one, Janet Yellen, who's already resigned, basically will resign here and step out of the position in January, has been the polar opposite of that. And in fact, she's dumped a pretty big debt bomb on the next administration, because normally when we finance our debt, right, which is over 36 trillion today, we finance it about 40% on short-term instruments, 5 years down to 2 years, down to T-bills, 90 days. So we finance on shorter-term notes and instruments, and then we finance the other 60% on the mid and longer part of the yield curve, 10-year, 20-year, and 30-year treasuries. Well, they've been refinancing everything for the last 2 years on T-bills alone. So we now have a mighty big amount of money that has to roll with interest rates higher, and that's going to increase interest on the debt from 1.2 trillion in the current fiscal year to 1.8 trillion next year, regardless of government spending. So people need to be aware of this. So his idea is to cut to the bone so that that interest payment would only be 3%, or the deficit would only be 3% of GDP. Got a lot of work ahead of him. He also maintains we must deregulate to have a minimum of 3% growth in GDP. Now, for the last 15 years, we've been averaging just under 2.7%. So we had a couple of big years, like after COVID, obviously. So that's a challenge. And then he wants to increase oil production domestically, whether it's through fracking, oil wells, offshore, et cetera, by a minimum of 3 million barrels a day. So that's his 333 plan. If he cranks up the oil, that will drive, and oil is reacting that way. Oil is back in the 60s. So that's good news. I don't know if you guys noticed if you filled up, but it's much cheaper this year to drive for Thanksgiving than it was in the previous year. So gas is below $3 nationwide. That's a good thing. So he's trying to drive down inflation by pushing petroleum costs down. And as we talk about many times, it's not just at your pump, Chip, gas. Petroleum goes in all your plastic bags you shop with, all the packaging and the materials you buy. It's in just about anything and everything you buy. Petroleum is a massively large industry. And so if we can get the expense or the cost of that down, that will help with inflation on the long end.
333. Well, what we're doing isn't working, so let's give it a try, I guess.
Absolutely.
Let's see if it'll work. Hey, David, you mentioned the Trump bump, and the markets have been relentlessly strong, and yet there's this dichotomy that we've pointed out numerous times, that at the grassroots level, where people live and work or lose their jobs and are trying to pay bills, there is pain. You sent me a CNBC story. AMD to lay off 4% of workforce, or about 1,000 employees. This is what was supposed to be the invincible sector, the tech sector, and the news just keeps getting worse.
Well, yeah, because in other words, there's an old adage on Wall Street: buy the rumor, sell the news. We talk about it all the time. So we've been in this AI euphoria for the last 18 months or so, and the largest company in the world, at least by valuation today, is NVIDIA, and so that's AMD's number one competitor, by the way. And so they have been growing so fast, a couple 100%. Well, their growth is slowing. The most recent earnings report, they beat on both bottom and top line. They beat on revenue, beat on profits, but their forecast of the growth is slowing drastically. In other words, they can't grow. You can't go parabolic forever. So we're seeing that whole sector, maybe it's ahead of itself. And we saw this from the earnings reports of the big seven, Meta or Facebook, Google, Amazon. They've already invested heavily in the CapEx to buy these chips for future use of AI and data centers, but they've already made that expenditure. So they're not going to continue to spend at that rate in the near term. So that means that the tech sector is actually going, but we put a chart up a couple weeks ago. Remember, tech sector jobs dropping off. It's not funny, but if you remember, when we shut down a pipeline, we had thousands of jobs right here in Nebraska lost a few years ago. And what was the administration?
Learn to code.
That was what they said, right? Well, now those coders are out of jobs, and you might want to learn how to be an underwater welder, because we're going to see a lot of offshore rigs, et cetera. Yeah. And those jobs, by the way, pay really well. So
learn a trade.
We've talked about that last week and the previous weeks. Trades are coming back, which I'm a big believer in. We need to take about 30% of our high school kids. They need to go straight into trade schools. They do not have to need to go to college. They need to go learn how to make a living, and you can make a very good living in the trades. So anyway, the markets are definitely overvalued, and we're seeing a rotation. Now, the good news is the breadth of the market has widened out in the last 3 weeks since the election, and optimism, including myself, among small business operators is up again for the first time in 3 years. So business owners are more optimistic of the future finally, based on the idea of deregulation and potentially lower taxes in the future.
Well, then maybe this poor guy can find a job. You sent the team just a little example. You said, the struggles are growing louder across the globe. And this guy is a project manager who just basically put a message out in social media. I'm a decent, functional project manager. I can't find anything anywhere. Somebody help. He was looking for an opportunity.
Yeah, and the problem is he moved out to Silicon Valley and took on a project managing job at one of the tech companies, was paid over $250,000 a year, very healthy salary, but they were flush with cash, so they overpaid and they needed people. I mean, I remember when the wage pressures during COVID were crazy. We were trying to find employees because we were busier than ever, and it was very difficult labor market. And so now you're seeing the labor market soften, and it's very different numbers now. And so people that are accustomed to getting overpaid are going to find their salaries are going to reset significantly lower. On top of that, you can expect 1 million people to be unemployed 12 months from now from the federal government that are currently employed today. So that's going to add to the softness of the labor market, and more people competing for jobs. It will drive wages down, not up, as they've been going for the last 4 years.
Up next, we have another round of Social Security classes coming up. That means it's time to check in with financial advisor Sean Swanson. He's up next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Smart Social Security Blueprint is one of our most popular classes. With us today is our resident authority on Social Security who teaches that class. David, please welcome our special guest financial advisor, Sean Swanson.
Thank you, Chip, so much. And once again in the studio, our resident authority on all things Social Security, financial advisor, pastor, and just all around good dude.
Oh, thank you.
Sean Swanson. Sean,
Thanks,
how
David.
we doing?
We're so good. We're so good.
So this is, we're recording this show this week, the day before Thanksgiving. So I understand you've got Ian, your son, coming back from D.C., and
Yes.
your whole flock's going to be over. So
I have already stepped on Legos in my household. So we got the little grandchildren running around, and it's going to be great. We celebrate Thanksgiving. We lost the lottery, David, so we celebrate on Friday. So they go to all the in-laws on Thursday. We get them on Friday.
Very good. Well, when you're wrapping up in the turkey and you're about ready to sit on the couch and fall asleep, there's going to be a football game that's going to be really cold this week.
Yes.
We're playing Iowa in Iowa, and I
Yes.
guess it's going to be 14 degrees game time.
Yeah, I'll
So-
be watching from my sofa.
Yeah,
Absolutely.
I will be too, in the comfort of the warmth. So I have a lot of family in town this week as well. But anyway, hey, on to some important topics, because we have our next round of Social Security Blueprint, the class that you lead so well. And there are some changes here coming about in the new year with Social Security. Can you talk about what you'll talk about in the class and maybe some of those changes we've got coming 1/1?
Yeah, first of all, we have a good time in the class. We don't just sit there and spew out information. It's interactive, and we want to make sure that people understand the major things about Social Security. So some key takeaways would be, number one, when we work for an employer, we pay 6.2% in taxes to the Social Security system if we're working for someone. If we're self-employed, we get to pay both sides of that, 12.4.
Well, yeah, and the employer pays 6.2 on your behalf as well.
That's right. And every year, a little sneaky additional tax, David, is the federal government raises the amount of income that's subject to that tax. And so
But wait a
January
minute,
1.
I heard somewhere if your income's below $400,000, there's no tax increase.
I don't know. No, that's
seems
not the
to
way
be
it
a
works.
lie, huh?
Yeah. So they raise the earnings so that you're taxed all the way up to an income of $176,100. So if you take 6.2% of that, if you were blessed to earn that much money or more, that means you're paying $10,918 in Social Security tax. And if you're self-employed, you're paying double that, $21,836. So make no mistake, we're paying into the Social Security system, and that amount's going up every year.
Well, and the reality is the majority of Americans, this is the single largest tax they pay, right? It is more than they pay in income tax, because the average American median income is the mid-60s now. And because of big standard deduction, et cetera, those folks are typically, their effective rate on income tax is about 5%, after deductions, et cetera, because they're typically going to be in the 15% tax bracket, and their effective rate is much lower. But they don't realize Social Security is a much bigger tax on most working Americans.
Absolutely. Yep. Two other quick things that would impact our listeners is the cost of living. was a adjustment was announced for what's going to hit in January.
Wasn't really big this year, was it?
No, 2.5%. So funny thing is they don't ask us how much grocery prices have gone up or college, anything else like that. Inflation is much higher in many areas.
Well, you have to understand the government is incentivized to suppress the inflationary wages on not only Social Security, pensions, government pensions, military pensions. Obviously, those COLA increases affect the budget process, right? So it is not tied to CPI, right, where inflation is monitored, primarily. It is actually tied to CPIW, right? And so they use a little number that actually goes up a little slower, and then they push the income, as you set up, a little faster. So that wasn't a 2% increase in the income, right? They jumped at almost 16 grand. So it's actually anybody earning over that $176,000 now actually just got about a 4.5% tax bill that they didn't have before.
The things that David Brooks knows, ladies and gentlemen, this is amazing. The other thing that was announced would be more for our younger listeners, or maybe the kids or grandkids of some of the folks that listen to our program. In order to get a credit with Social Security, within a 3-month period, that number has been adjusted as well. You have to earn $1,810 in a 3-month period. So when you think about it, even when I was back in high school, I was working at a grocery store. I hit that credit in a 3-month period. But as we're going to learn, and I'm not going to reveal right now because I want people to come to the class, we're going to reveal how the Social Security is actually calculated. So they have to come to the class.
Well, none of that. You actually show them how it's actually taxed, which
Absolutely.
is not exactly the easiest formula. And unfortunately, it should have never been taxed. But anyway, that's a story for another day.
That's right.
Now, what I'd like you to do, can you speak briefly to those? Because a lot of Americans are struggling. Let's face it, inflation, true inflation, is up about 26% the last 4 years. So we have people that are in the bottom half of income earners in America that are struggling because of the day-to-day expenses. So we have seniors that, unfortunately, it's not typically our client, but they're stepping into retirement and they're still having to work or part-time work. There's an earnings test they need to be aware of, right? Because if you earn too much money, you can actually get penalized if you're taking Social Security early. I had this discussion with someone the other day. They're like, well, I'm just going to turn on Social Security at 62. And I'm like, are you sure about that? Well, I really wanted, it's going to be like $1,600. I know I could wait and get more money, but I could really use the help right now. I was like, so can you kind of explain, if you turn it on early and then you're still working, you can end up giving back a good chunk of that check?
Yes, unfortunately, this is true. And before I even answer that, when people come to the workshop, the seminar, one of the tools that we offer for free to them is a Social Security maximization tool. So I want to make sure people know that we can help them with this decision. So let's say that we decide that we want to take Social Security at 62. Well, the first gigantic impact is that you're going to take a big hit on the monthly amount.
30% reduction.
That's right, 30% reduction. And then the reason why we around here at Retire Smart, if someone were to wake us up at 2 o'clock in the morning and say, when should I take Social Security? My default answer is your full retirement age. And the reason being is by doing that, you're avoiding a lot of pitfalls that I can go through if you want.
You can also eliminate the earnings test I was just talking about, right?
That's
so you don't have
the
to
main
worry.
one. But if you were to go and to turn on Social Security before full retirement age, the earnings test is sometimes in our business referred to as the clawback. And here's how it works. In 2025, you can earn up to $23,400. But if you've turned Social Security on and you've got a part-time job and you're earning more than that, here's how it works. From there, you'll have $1 in benefits withheld per $2 of earnings over that earnings test. So what that means in English is we'll sometimes, you and I will call that a 2-for-1 clawback, but you're actually going to have a reduction to what your Social Security check is coming to you. They don't take that away from you. They're going to restore it back when you finally do get to full retirement age.
But they only give it back to you on an actuarial disbursement.
Oh, with no interest?
Yeah, with no interest.
on
So,
your money.
so it slightly increases your check later, but it's not like it comes as a lump sum up front and you get the COLAs on it. So the other thing I want to point out is there's some significant changes. We had some laws passed here on Social Security. So what's called WEP is going to go away.
Yes.
That is good news for those that worked for typically the federal government, some people in the pastoral world. So if you earned income and qualified for a pension But when you earn that income, you did not pay into Social Security, and this was a majority of government employees for many years. So you could there was rules changed where you could opt in or out. But if you were one of those folks that did not pay in, you get a reduction in your Social Security because you never paid for it, basically, right? So if you still qualified and worked outside the government in this example or other entities, so. Anyway, good news is that is going away. It doesn't affect a ton of people, but that is really good news. That's going to be going away here in the near term. So again, this is not for the faint of heart to decide, right? There's over 500 combinations if you're a married couple of how you could decide when and where to take Social Security. The odds that you choose the exact one are about zero, right?
That's right.
And of course, we can't promise that we can make the perfect choice. Now, unless you know your expiration date, if it came like on a carton of milk, and people like expiration date. Well, I don't want to say you're dead, but let me explain to you. This is when your plan expires, Tom. So if we know that date, we can tell you not only the exact day to maximize Social Security by drawing, but then you're going to take it further and show them how to optimize it. Talk about that.
Yeah, optimizing is where it's all about. We'll show a slide in the Social Security presentation that I say, hey, if you guys only pay attention to one slide, take a picture of this one in your mind or write it down, because it's going to talk about how to have the maximum benefit. And you're right, David. If we did know exactly how long someone was going to live, we would know mathematically when to turn on. But in that optimization strategy, we use powerful software to help us show you and run a bunch of different calculations to show you, if you live to this age, this is how much you'll collect. If you live to this age, this is how much you would collect. And just to simplify, if I could, again, if you woke me up at 3 o'clock in the morning, my default option would be take Social Security at full retirement age or later. My second option, just getting back and closing the loop on the earnings test, would be if you wanted to take Social Security in the year that you turn your full retirement age, there's a much bigger earnings test. That is $62,160 that you can earn in that year. So again, this can get quite complex in a hurry. That's why we do so many of these Social Security seminars and why we help our clients to navigate that.
Yeah, this is a very popular class. And again, that's coming up December 3rd or December 5th, 6:30 p.m. at the Midwest Learning Center. Just go to their website and click on the events page. But you do need to register because the classes do fill up. We are out of time this week, Sean. So I hope you and your family have a blessed and wonderful Thanksgiving.
You as well. Thank you, David.
All right, Chip, what do we have next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go, David. First question is about the markets. What was the impact, if any, on financial markets from the recent Microsoft outage?
There wasn't really much of an impact financially on there. I actually found out because I'd messaged a team member. We use Microsoft's Outlook 365 product for all of our employees, and they have a communication tool called Teams. A lot of companies use it, and that's how we inter-office communication. And I sent a message. I'm like, why is nobody answering back? And then I come to find out, somebody let me know, there's an outage, Microsoft. And unfortunately, this is becoming more common.
There must be backups and fail-safes and things, I suppose.
Correct. But what happens is somehow glitches happen within the programming and coding, and they shut down portions, the entire globe go dark for a short period of time. Then they fix it and they code. So we're talking about people learn how to code. They still need them. And then fix and patch those. Now, it doesn't have quite the impact today that it does because they're able to fix these so fast. I mean, usually it's like a 2-hour window. These things go down and they're back up. But it is disruptive if you're trying to communicate as a small business owner. But the stock didn't overreact one way or the other. I remember if you go back 2+ decades, eBay back in the 1998, 1999 was just coming into its own as this online marketplace, and their servers crashed and their stock went down like 20% in an hour, because they didn't have the redundancies they have today. Today, I mean, especially, it right here, starting to call this the Silicon Prairie. Right here in Omaha, we have server farms. I live on the south side of town, and if you've ever driven out towards Springfield or Louisville on 144th, that's all it is out there, is these server farms, and they're continuing to build them as fast as they can. So they build these all over the globe. to have redundancies so the companies won't have these outages. But that's a very real fear of mine. Is we use the cloud, so to speak. So most software applications today are not on your physical device, your phone or your laptop or your computer. You're using cloud-based services, and if they are to go down, it can be very disruptive. Imagine you're having surgery and they were using data for that surgery from the cloud, et cetera. So there could be some real implications, and that's why it's really important that we have fail-safes built into these systems.
Well, we utilize dozens of programs and things, to analyze the markets and work up optimal portfolios for people.
And so not only that, we have to store our clients' information, encrypt it, et cetera. And so we not only do we take that seriously and have multi-factor authentication to get access to the data that we store in the cloud, but then we also have to have cybersecurity insurance. So we pay a healthy fee every year to insure in case, because in the reality, let's face it, the data breaches. I mean, we had a big deal here with CHI Hospital this past year where they got ransomed for the data. And again, these are not when it's going to happen. It's no longer if, it's just a when. So you have to be prepared up front to have things in place. So we have redundancies on how we store data as well for client-specific information, et cetera. And so anyway, this just talks to a much broader issue.
David, the next question is about year-end planning. It's almost December. Are there moves I should consider making in terms of year-end planning?
So there are many things that you should be looking at doing for year-end tax planning in particular. So depending upon whether you're philanthropic or not, or if you're a charitable giver, I always tell people, like I actually just loaded my donor advised fund up with a very large sum of money this past week. So we get to the end of the year. And so one of the things you can do, if you don't know, a donor advised fund is one of the things we often advise clients to use. This is an account that you control. In this example, I control it. So I like to own stocks, right? So I buy stocks and they've risen in value this year significantly. So I don't want to pay a capital gain chip, so I can transfer my stock into my donor advised fund, sell it inside the fund. Now it's in a charitable account. There is no taxation to me. The money that I was going to give to charity this fall, this Christmas, and I do this actually for many of the gifts we give for the company's behalf. I actually give those checks a lot from my donor advised fund. I then put my cash into my stock account, buy the stock back tomorrow. Now I still own my stocks, but I never paid capital gain, and I've moved my cost basis up significantly, so I would never have to pay tax on the gain in those stocks. So this is just, you don't know what you don't know. But this is one way, if you happen to be charity inclined, if you use a donor advised fund and you happen to own stocks, we can pair the two together. You can still do charitable giving, give the same money to the same entities in the same order, but eliminate a tax. Plus, you're going to get a tax deduction for what you gift to the donor advised fund.
Better for you is better for the charity?
Yep.
Yeah.
Now, depending on where your income is, you can also prepay property taxes if you're not using up your SALT deduction. So if your property taxes were $5,000, the SALT deduction allows you to deduct $10,000 a year. Go ahead and write your check.
SALT, state and local tax.
Yeah. So go ahead and pre-write next year's property tax on your home to the county, Sarpy, Douglas, whatever you live, and now you can take the full $10,000 deduction if you choose to itemize. The other things you can do is you want to do what's called tax loss harvesting. So if you have investments in non-qualified accounts, these are accounts that you pay tax on every year, you can sell a loser and pair it with a gainer, rebalance your portfolio, de-risk your portfolio. This is called tax loss harvesting, and not pay any tax or capital gain on the gains in that portfolio. So again, this is something, if you're working with a competent professional advisor, this should be done for you already. But if it's not, those are just a couple of tips you can certainly look at doing year end before time runs out.
Well, speaking of working with a competent professional advisor, the next question is about choosing as an advisor. I heard you talk about the guy who wants to test the waters on financial advice, but is trapped because his current advisor is his wife's brother. That got me thinking about my situation. I don't have an advisor. I'm 59, I'm single, I plan to retire at 65, and it's time for me to get some professional guidance. What questions should I ask when interviewing potential advisors?
Well, if you're listening to the show, we talked about marriage last week. We talked about actually performing marriage this week. So ask them, do they have a dating app? Do they know how to pair you up with another client? Maybe one who's got more money than you. No, I'm just kidding.
David. Yeah. Our compliance officer, your brother Lou, is blowing a gasket right now.
So what you should do, and this is a great question, by the way. So if you've never worked with a professional advisor, you really need to understand the questions you should ask. So one, I would ask, What is your education and background in here? Do you have any certifications? There are several of them in the industry. We have down our hall, I think 20 different sets of letters behind the advisor's name. So we have advisors become specialists or experts, if you will, in different areas. And so you're going to want to find out, what are the qualifications of the advisor? How long has the advisor been doing this, right? So, and there's nothing wrong with younger advisors, by the way. We have a lot of great ones here.
We have some great young talent
but
here.
But are they working in a collaborative environment? So if your advisor is 25, there's nothing wrong. We have superstars that are 25-year-old advisors
here. But does he have a David Brooks looking over his shoulder?
Right. Do they have the collaborative, do they have the team behind them to give you the areas of expertise and knowledge that you want? The way we do it is, we had Sean on the show earlier, right? So Sean is kind of our resident authority, as we said, on Social Security. We have Mike Schutel, who comes on and talks about estate planning. He actually has a law degree, as do you. So we put together the educational background. We think we've built a great team. So you're going to want to ask, what's the education background of the advisor? What certifications may they hold? What is their experience level? Do they work in a collaborative environment? Then you want to go further. Does their planning include the type of planning you want? You may just want someone to help you pick investments. There's nothing wrong with this. So I refer to this as accumulation advisor. I was one of those early in my career. I just went out, and anybody that wanted to invest money was a potential client, and I would invest the money and try to grow it. And so do you want an accumulation advisor, or do you want a planner? Do you want someone who actually does holistic planning, tax planning, income planning, risk management, legacy planning? And different advisors operate differently. So ask these questions. And the most important thing you should ask is, how does this advisor get compensated? We do expect to get paid, right? So it's kind of important. And some people want to sweep it under the rug or not talk about it. You should ask openly up front, how do you get paid? And then the last thing I would say is, are you operating as what's called a fiduciary? Doesn't preclude you from working them, but there's suitability standard advisors.
What does that mean to say you're a fiduciary?
It means legally they are obligated, and we do it contractually, to do what's in your best interest, even if it's not in the firm or the advisor's best interest. And that could deal with how they are getting compensated, right? So there are advisors that are commission-based, and there are advisors that are typically fee-based. And you want to understand what type of advisor you're working with. Like here at Retire Smart, we do not earn commission on any investment security product ever. We are a fee-based advisor. However, full disclosure, we charge a financial planning fee for most clients because the level of work we do. That allows us to lower the fee we charge for the investment side. And on top of that, we may recommend some form of insurance product. All of our advisors are licensed insurance agents, and they have to be, because if you need life insurance for your estate plan, we need to put that in place. Well, guess what? There's commission embedded in those products, and they will pay us. We just disclose this to clients. So how does a guy get paid? Does he disclose it to you? And just make sure you understand all that. So great question. And meet with maybe two different offices, and then you can kind of get a feel for what flavor you're looking for.
Up next, opinions about Bitcoin shift as dramatically as does the value of Bitcoin itself. We look at several Bitcoin-related stories next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. A lot of Bitcoin-related items here, David. First, you sent the team something. This is Jim Cramer on Bitcoin, and Cramer, at one point, he was calling it a scam. Then he calls it a winner, and Bitcoin seems to move exactly the opposite of what Cramer is saying. Well, what's going on here?
Well, a friend of mine, Matthew Tuttle, runs the inverse Cramer ETF. There's actually a product you can buy that trades, exact opposite of everything Cramer touts on CNBC's Talking Head. I just think it's funny because there's so many times that it's easy to capture him being wrong. Now, he's been right many times too. Let's talk about that. But here he is, on the screen. We have it for those who watch it on YouTube. January of 2023, Bitcoin's phony and it's a scam, right? And since that date, Bitcoin has gone up, I think, 450%, right? And then here he is this week, November 22nd, 2024, Bitcoin's a winner. And immediately this week, Bitcoin sold back off 7 or 8%. I mean, almost instantly. I just think it's kind of funny. But the reality is, listen, Bitcoin is not for the faint of heart, right? So it's a digital asset. It's a storage of value. I personally own Bitcoin, so I'll disclose that. And we do actually use Bitcoin via an ETF through Fidelity in one of our portfolios for clients to have a small percentage of exposure. And of course, it's not appropriate for all clients. But you need to understand, right now, there are things going on out there that I would want you to be cautious on. And there's a company I sent you some information on called MicroStrategy.
This is a little more serious here, what's going on with MicroStrategy.
So MicroStrategy, we've got a chart on here, went parabolic by using some, let's just call it creative accounting back in the dot-com days, excuse me. And so the stock went to the moon and then, of course, went right back down. Those you can see, there's no roller coaster that's even this steep, right? And then here we are 2 decades later, and once again, it's doing it because what they're doing is MicroStrategy. And again, listen, if you happen to own this stock and it went parabolic and you happen to sell it, kudos to you. This is not typically the type of investment we are going to use for retirees' portfolio, right? But what's happening here, and I've actually brought a graphic along, infographic to show you, is what they're doing is they're basically putting bonds out. They're borrowing money through bonds on the company's balance sheet, purchasing Bitcoin, which has been going up in value because of the election, right? Because Trump is going to be considered pro-crypto. Then as the value goes up, the stock goes up. So then they lend out more money in bonds, take more money and buy more Bitcoin. It's a Ponzi scheme in my humble opinion.
I'm looking at a term. It says reflexive flywheel effect. Well, gee, that's a nice way of saying Ponzi scheme.
Yeah, and so the rug, and that stock, by the way, is down over 35% in the last 5 trading days. All right. So again, not for the faint of heart. And so I actually looked up the options because I personally was like, well, maybe I would want to short this. It was $220 per share to buy a put when it was trading at $550. That's crazy. But anyway, so these are the type of investments we want people to stay away from. If you don't understand it, you shouldn't own it. And you should not be trying to gamble your way into a successful retirement.
Well, all this action around Bitcoin is drawing the attention of the IRS. The Wall Street Journal headline is, Bitcoin is surging and the IRS is watching closer than ever. The cryptocurrency holders are cashing in on a large surge in Bitcoin prices, but the IRS is stepping up oversight. Any taxes owed will need to be paid. The IRS considers crypto property. See, I have a hard time wrapping my head. Is cryptocurrency? Is it property? Is it a commodity? Is it all of those?
Well, this is the problem: is Congress has never properly legislated that out to us, right? And then the now retiring head of the SEC, Gensler, has been very adamant that he wants full regulation on crypto, but he will not call it a security. Well, that puts me in a hard place, Chip, as we talked about this. As we can't recommend it because my license is for securities. Well, crypto is not classified as a security under U.S. law. So therefore, that's not something that I can now. So how do we have exposure to Bitcoin? Well, we purchase a security instrument for our clients, which is called an exchange traded fund that owns the Bitcoin. But I can't buy the direct Bitcoin for my clients. I can buy Bitcoin directly personally, and I do. I own Bitcoin. I own several other
legally
cryptocurrencies.
Or transactionally, it's one step removed from being a security. But it's sure, they say, does it walk like a duck? Does it quack like a duck? It sure seems like a commodity or a stock.
Here's the reality, right? Governments, not only here in the U.S., but around the world, are not going to let it go unfettered, unregulated, and untaxed. So you are now going to see legislation catch up. Just like the internet, we didn't have legislation to properly regulate and tax commerce on the internet, right? Amazon only recently, the first decade, they didn't have to collect sales tax. Now they collect it in every jurisdiction across the country, right?
So the IRS is going to define it in the way that best allows the IRS to get its piece of the action.
So here's the reality.
That makes sense to me.
So if you're purchasing these instruments on exchanges, they're going to give you some, like Coinbase is the most popular one out there, and I happen to personally use that, but they give me a tax report every year, buy and sell. Where I want to make people aware, cautiously, people don't realize the tax rate they'll pay. Now, we have yet to define it. If it's defined as a collectible, you'll pay a higher tax rate than you probably realize, and this is the same with gold and silver. Those are taxed as collectibles. That's a 28% tax rate. And if you're buying and selling this in the short term, Chip, it's not a long-term capital gain. It's taxed as income. And if you hit it, let's just say somebody owns, and I have a friend in Florida that owns quite a bit of Bitcoin, and when it went from $40,000 this year to $100,000, he cashed in and he was talking about, hey, I'm going to buy my dream home because he had owned enough that it was a pretty big gain. I'm like, you realize you bought some of that earlier in the year because I had a conversation with him. That's taxed as income, which now means he's taxed at 37% federally on that, not 15% capital gains or 20% capital gains. And he's like, what? I'm like, yeah, you want to talk to your accountant. So again, you don't know what you don't know, and you simply need to make sure you understand what's going on in the tax and legislative world with these things. Because yes, the IRS knows people cashed in this year, and they're going to want to get paid.
David, I want to squeeze in a chart that you sent to the team about U.S. household debt. that it's hit a new record of 18 trillion.
These are not the kind of records we want to be proud of here in the U.S.
Most of it's mortgage, credit cards, auto loans, and so forth. What does a chart like this tell you?
Well, it tells you the consumer is being tapped out, and we've been talking about this for a while. And so the consumer can't afford to continue to purchase things if they are burdened with debt. Credit card interest is at all-time record high at 23.4% is the average rate on a credit. That's average, Chip. That's almost usury fees in my book, right? That's the average Americans, and Americans are carrying a balance. In particular, seniors have increased their balance by over $2,500 year over year. Retirees, that's not good if you're having to carry a balance in retirement. You know, the idea is to enjoy your golden years, not be a slave to just paying interest payments or minimum payments. So the consumer is tapped out here, and mortgages, of course, are not going. The rates are not going down. They've gone up since the Fed started cutting rates in September. We have 7% mortgages, so I don't see any improvement on this in the near-term future. On top of this, we have the debt swell. Even worse than this is the federal government we talked about earlier in the show. So we have a debt tsunami that's going to take some massive growth in the economy where people can earn more money, where we have wage inflation going, but we would need GDP to grow significantly for that to happen, 4 to 6%.
Well, just in about 30 seconds then, that must be why the Conference Board of U.S. Leading Indicators said this index is down for the 32nd consecutive month.
32 consecutive negative months. And this is a leading indicator of where business operators and CEOs see. By the way, we don't have the chart here, but as of this week, we now have officially more CEOs resigned this year than any year in history of publicly traded companies. Almost 2,000 of them, 1,890 something as of this morning, have resigned. That's about 400 more than last year, which was a record year. And so why is that? Why would CEOs step down from cushy jobs? Well, they know that the future is probably not looking as bright, and most of these CEOs are paid on the performance of their stock. So if their stock were to go backwards over the next 24 months, their pay package would drop significantly. So they're probably cashing out and taking those golden parachutes while they can.
Well, we'll keep an eye on all of this for you, but that'll do it for this week. Please visit our events page at retiresmartomaha.com to see everything we currently offer. There's no charge, there's no obligation for our events, such as the Social Security class coming up, but you do need to register. You can do it online or by calling 402-369-7777. David, bring us home.
Hey, I hope you had a blessed Thanksgiving week with you and your family, and stay warm out there. We'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week.